traders, and welcome to the premium video newsletter for August 13, 2013. Let's start off with the fundamentals and work our way into the technicals from there. The U.S. economic reports were mixed to slightly bearish, as July retail sales increased 0.2% when a 0.3% advance was anticipated in the retail sales report, excluding autos, which were up 0.5%. which compares to the median estimate of a 0.4% gain. July import prices were up 0.2% when an increase of 0.8% was estimated. Although smaller than expected, the increase in import prices was the first gain in 5 months. Technically, the broad market was mixed today, and once again flirting with the 1680 low level on the downside. The broad market is mixed right now because there's a bit of weakness coming in from other sectors. For now, I'm anticipating the S&P to stay at the current levels and possibly drift a bit coming into tomorrow. I do want you to pay attention to the 1680 level, and I will show you why right now. The transports are very important during critical levels, and notice that although we are not trading much lower, we did take out the low today. This is very important because the transports can weigh heavily on the broad market, as we have seen in the last few days. Also, take a look at the financial sector. This is a very important sector, and we did take out the low today in this sector as well. One reason why this is occurring is because this sector is very strongly influenced by interest rates. And if yield keeps increasing, it may slow down the upside to this market. Let's take a closer look at the bond market so we can see why the financial sector made a lower low today. Before I get into the interest rate sector, I want to talk a bit about the tech sector. If you notice, and I did point this out during the weekly Outlook newsletter I sent out on Sunday night, the NASDAQ is not as sloppy as the S&P, or the broad market as I like to call it. One of the reasons is because interest rates don't play as big of a role in the techs as they do in the broad market. The broad market includes many financial and banking companies that are directly affected by interest rates, while the tech stocks are more indirectly affected by the interest rates, so this is why we're seeing a bit more strength in the tech sector. Also notice the semiconductors, which are not moving much higher, are appearing to be a bit stronger today. This is also adding to the strength of the NASDAQ index. The yield on the 10-year U.S. government bond acts as a benchmark for interest rates on mortgage loans. So when government bonds yield rise, they push mortgage rates up, which makes financing the purchase of a house more expensive. And this is one of the reasons why the financial sector is weak today. The 10-year Treasury yield hit 2.71% early Tuesday, up from 2.62% late Monday. Long-term interest rates are still near historic lows, which has been a boom to the housing market in the last year. To give you some perspective, the 10-year Treasury yield was trading around 4% in the summer of 2008, shortly before the worst days of the financial crisis, and I'm expecting yield to go up to 4% within the next year or so. Official figures are expected to show that the Eurozone recession, which has lasted since 2011, ended in the second quarter. Eurostats, the European Union Statistics Office, is expected to report Wednesday that the economy of the 17 countries that use the euro grew by 0.2% in the April-June period compared with the previous quarter. The increase is slight, but it would end 6 straight quarters of a debilitating recession, the longest to afflict the single currency bloc since its creation in 1999. Germany, the region's economic powerhouse, is widely predicted to have been the major contributor to the growth we've been seeing. Other countries like Greece are also seeing some improvement in economic activity, but remain in a recession. Technically, the euro right now looks like it's hitting long-term resistance and backing away short-term. The next support area is around the 132 level, and if we break that level, we could theoretically go down to the 128 level because there's very little support in between. The market is still fairly range-bound and has been for the last half year, so we have to see something a bit more long-term in terms of stability before the euro can break out for the long term. What we have now is some positive forward-looking statements, but till we see the actual currency valuation higher, we won't see much upside. I'm anticipating another month or two of cycling unless something totally unforeseeable happens. Right now, it's too early to analyze breakouts because we're simply not there. So let's be patient and trade the range-bound cycle for now. The price of crude oil rose Tuesday as government reports indicated consumer spending could boost economic growth in the months ahead. Technically, I'm very skeptical we will break the high 108 area, but we could see further buying action towards that level. I'm frankly seeing more weakness here because I would expect to see more volatility and wider trading range if we were going to break the high 108 level. So far, I'm not seeing it, and unless fundamentals are incredibly friendly tomorrow, I still think we will begin slowing down and seeing more selling come into this market for the rest of this week. There's a few setups I'd like to look at for tomorrow. There's a tail gap to the upside. Ticker symbol is YUM. Place a buy stop 10 cents above today's high, and if filled, place a sell stop 15 cents below today's low. The second setup is a 4x4 to the long side. Ticker symbol is IHS. And the rules are similar to the previous trade. Place a buy stop 10 cents above today's high, and if filled, place a sell stop 15 cents below today's low. That's it for tonight. I will update you tomorrow morning and earlier if I see something unexpected happening. Have a great night, everyone.